Profiting from market panic, a lot easier said than done. That's all I want to tell you. Because as much as anybody wants to teach or much as anybody wants to explain stuff, profiting from market panic when you're a retail investor is incredibly difficult. Let's go next slide. Because you can't really see the noise. You can hear the noise. You can't see the noise. When the market sells off, many people may be hesitant to sell strangles because of the risk of getting whipsawed to the upside or a continuation of a rapid down move. But can we profit from market panics? Let's explore this hypothesis and see how we perform when we have sell-offs of varying magnitude. What I meant by that statement I just made before is that, like, if you can hear the panic, it's you kind of. That was one of the advantages, I think, of trading in the pits and on the trading floor, is you could hear the panic. And when you can hear somebody else panicking, you kind of have an idea that where the market, you can hear the capitulation. When you're trying to see it on a screen, it's way more difficult. I mean, I don't know if you feel the same thing.
Nobody talks. Every day looks the same. I mean, like,
everything looks the same.
Screen.
Right. It's when you're watching panic, it's very difficult because you can't hear the pain. You can't
gauge it. You don't. It's just a number on the screen. It almost becomes
exactly
surreal.
Exactly. Like, there were times on the trading floor I didn't even care what I was trading because I just knew that I was buying something when the broker was just puking it. I didn't care what it was.
Yeah, everybody had to do something.
Yeah, it was just like, this guy's puking this, so I'll buy it. I don't even care what it is.
Mm-hmm. Mm-hmm.
You don't get that sense here, and it's a very different world. So it's much harder. It's much harder to profit from market panic on screen-based trading. Now, the advantage of screen-based trading, what we do is it's easier to trade. Yeah, because you actually get filled, so trading's easier. But profiting from market panic, very difficult, because again, you can't hear the emotion. You can't feel it. You can only see it, and seeing it's not the same. This is a 10-year study. 16 Delta strangles, 45 days to expiration, managed at 21 days. We're just going to show you some statistics because the statistics have a lot of takeaways. We're going to compare the average P&L, the premium win rate, return on investment, when the trade was initiated on any down day, down 1%, 2%, or 3%. Today, right now, we're down over 1.5%, just to put context around this. Yep. 1% move would be
2.5% in the NASDAQ.
2.5% in the NASDAQ. 1.5% in the Russell, 1.5% in the S&Ps, and in the Dow, not even 1%. Nobody cares about the Dow. All right, let's go next slide. So the larger the sell-off, the larger the profits, the larger the return on investment, while the win rates remain consistent across the board. Let's take a look here. So this is from just selling a 16 Delta strangle, and you can, all days, all trades, any down day, 1%, 2%. I mean, the simplest takeaway from this, if you have if you can pull the trigger, is everything remains the same except you make more money and a higher return on investments when we're down the most, which I don't think would shock anybody, but it's the hardest. When it's hardest to do something, you get paid the most. That's the simplest way to explain it. So why do we see greater profits from strangles when the market sells off, even though the price moves tend to be large? So larger sell-offs come with added volatility and larger strangle premium that's collected, thereby providing extra protection to premium sellers from outsized moves. What this means is you have less outlier risk. So the net results are better because you make more money, you have less outlier risk, and the win rates are virtually the same. It's hard to think about this, but the win rate when we're down 2 and 3% is the same as on any given day. Like, that's the most important thing. The win rate's the exact same. So why not make 25% more money or whatever it is?
Sure.
Now, again,
Your buying power is going to be the same. Almost everything going to be the same.
Now, again, easier said than done.
Of course.
Because right now we're not sitting here pulling triggers. Okay. You don't hear the ding going off. I'm not selling a crap load of strangles in Apple, for instance, right now. I haven't had a chance to really look, but I'm just saying, that's that's where we're at. Anyway, the numbers are interesting. They speak for themselves. Okay.
They do speak for themselves. Yeah. It's hard to look at these numbers when you have a market moving 2%, right?
Some of the takeaways: single down days or short-term sell-offs provide excellent opportunities to sell strangles due to the higher implied volatility, the higher P&L, and the premium you collect. Let's understand something, though. You have no idea what is a single down day or a short-term sell-off. Is a short-term sell-off mean it's going to end today? Is it going to mean it's the end this morning? Is this going to be 2008 where it ended, 6 months from now? You just don't know.
That's correct.
So it's not, in hindsight, it's easy to do this. In real time, you can't tell where that capitulation is because you don't hear the panic. So generally, that's why you got to stay small. So a little bit to support what Jim said this morning, but also go contrary to it. The best time for the best returns is to get involved when the fewest number of people want to. But the flip side of that is you have to stay small.
It always comes down to that.
Selling strangles after down days saw an increase in average P&Ls for a strangle because of the rapid IV increases and the premium. Sometimes selling into heightened volatility can be risky if the market continues to move strongly in one direction, and down days can sometimes be the beginning of larger corrections rather than a one-off event. We've spent many years dealing with one-off events. Maybe this is something more. I don't know.